So I'm going to talk about the economic forecast that the Bank of England published 2.5 weeks ago, and also the monetary policy decision at the time, and what we're predicting for the UK economic outlook. Now, in summary, there's some good news in the sense that we think that inflation has peaked and it's likely to come down quite sharply over the course of the coming year. Now, what that then means for interest rates is less clear, however, because there are risks around that. We're reasonably confident that inflation is coming down, but the bit that we're less sure about is whether inflation will come down and stay low in a sustainable way, consistent with our 2% target. And I'll go on to explain a little bit more about what I mean by that. But the sort of gloomy element of the economic outlook is the fact that we think that the economy is going to be very sluggish. We are going to have a technical recession, and the outlook is gloomy because we don't think there's sort of signs of a strong growth. So economic conditions are likely to be tough for some time. And again, I'll go on to explain exactly what I mean by that. So starting first of all with interest rates, which we control at the Bank of England, in order to meet our remit, which is hitting 2% target in the medium term. And we have raised interest rates at the Bank of England successively over the last 10 policy decisions, going back to December 2021. And you can see from this chart, that's a very rapid increase in the official interest rate over a relatively short period of time, some 15 months or so. And that certainly, will have come as quite a shock to many people, particularly for a cohort of borrowers who haven't known interest rates at this level before, because they have been accustomed to very low or almost record low interest rates for a number of years post-financial crisis. And again, you can see that on this chart, from around sort of 2008-9 up until 2021, UK interest rates were very, very low. And indeed, when we started our rate tightening cycle, they were at an all-time record low of only 0.1%. So therefore, the successive increases, certainly has been exerting, deflationary pressures on the economy, because we're trying to bring down unacceptably high inflation currently. But another thing that I'd like to emphasize is that bank rate at 4%, in some senses, you can consider this a normalization of monetary policy, because it's taking the official interest rate back to a level that preceded before the financial crisis. And you can see in the left-hand side of this chart, in the earlier years, 2002 up to 2008, 4% is in that sort of ballpark. So that wasn't that unusual back then. Now, the big question that everyone is wondering is, where are the interest rates going? Will they top out at this 4%? Are there more rises to come? Or indeed, are there cuts to come? Now, this is the bit that's highly uncertain. And even the 9 members of the bank's Monetary Policy Committee have very differing views about this. And indeed, throughout this whole interest rate tightening cycle, in each of these 10 policy decisions, there has always been a mixture of opinion amongst the 9 committee members about what is the appropriate policy decision, how much to tighten, and indeed the direction of policy. And I think that speaks to the fact that the economic outlook is a very complex one at the moment. There are economic forces moving in opposing directions, and therefore it's difficult to calibrate and assess what the net effect of these opposing forces are, and therefore also, what is the correct policy to guide the economy in order for us to meet our remit of achieving sustainable, long-term inflation back at our 2% target, because we and everybody else recognises that the current level of inflation is unacceptably high because it is way above our 2% target. Now, by convention, the Bank of England produces our economic forecasts, taking it into consideration the market expectation of official interest rates. And this chart shows those financial market expectations for official interest rates, both here in the UK, in turquoise, and in, for example, the US in orange and the Euro area in purple. There are a selection of lines shown. The dotted lines show the expectations 3 months ago, the time when we last published our forecast back in November, and the solid lines show the current expectations when we published our forecast earlier this month. And the thing I'd like to draw your attention to in particular is that in the UK, those market expectations for future official interest rates, they've come down quite a bit over the last 3 months. And there are a number of reasons for that. Back in November, you may recall, that was not long after the mini budget, and around that time, official and market interest expectations of official interest rates had picked up quite sharply. Now, the political situation has been more stable since then, and market expectations of interest rates have calmed down, and they've come down. And so currently, they're suggesting a peak in UK official interest rates of around about 4.5%. And they are also suggesting that by next year, the MPC will be starting to cut rates gently over the next couple of years. Now, whether that does indeed happen or not will really depend on what happens in the economy. And I'll go on to sort of explain, for example, what we're thinking about in terms of inflation and the labour market and wage inflation, and how that will be informing subsequent MPC decisions. Market expectations of another 50 basis points. So currently, bank rate is 4%. The markets are expecting maybe another 0.5 percentage point. It might be less than that. It might be 0.25%, or it's possible that we might top out at 4%. This is something that we'll have to monitor as time passes. Now, I mentioned a short while ago that the relatively good news in our forecast is that we are reasonably confident that we think that inflation has already peaked in the UK, and we are expecting it to fall quite sharply over the coming year. Now, the reason for that is partly related to the way that inflation is calculated. So inflation measures the change in prices relative to a year ago. And we think that in particular, the energy has been a big driver of pushing up inflation over the past 12 to 18 months. And we see that as pushing down on inflation over the next 12 to 18 months. Now, even if energy prices, so your own gas and electricity bills, for example, even if these do not change much, meaning they remain at a high level, the inflation rate mechanically does not continue to rise, or it doesn't stay high. So that's what's sort of pushing down on inflation. You can see that in the purple bars. So by the time we get to sort of spring next year, inflation will actually be, from energy, will actually be negative, and it will be pulling inflation down. Now, even if we exclude energy, so that's the orange line, you can see that other drivers of inflation also appear to be sort of easing off over the next year or so. So that's good news, and that's what we've been trying to achieve through all of those successive increases in interest rates. We're trying to bring inflation down because it's the highest it's been for some 40 years, the highest in a generation. And it's been in double digits since last summer. And so we've been doing our very utmost to try and bring inflation down. And we hope to see good progress on that over the next 12 months. I think the bigger question for us is beyond the next 12 months, because we know mechanically that these energy prices will be pulling down on inflation. What we're less sure about is, where does inflation in the UK settle beyond the next 12 months? What are the fundamental underlying drivers of inflation, and will we see inflation settle back close to our 2% target or not? One of our concerns is that this experience of very rampant high inflation will alter people's perceptions of where inflation lies in the medium term, and in particular people's pricing, if they run businesses, and then also their wage expectations in terms of how much they want their pay to rise in order to compensate them for cost of living. And the MPC have communicated this a great deal in media interviews, for example, that they're concerned about the risk of persistent inflation. And a particular phrase which we don't use, but you may see picked up in the media. If we think back to the 1970s, this fear that they might be a sort of wage price spiral type of dynamic, where once high inflation occurs, it can become embedded in the economy because people expect it to remain high, or people are passing through cost rises into prices, or they're bidding up their wages, and then that sort of behaviour almost bakes inflation into the cake, if you like, in terms of it being sticky in the economy. And that's what we want to guard against. And that's why I think the Monetary Policy Committee have been saying publicly that they want to see more evidence in the data that we can be confident that inflation, not only is it coming down over the coming year, but that it will remain settled, and it will come down as far as close to our 2% target. That's what we're aiming for. Now, I mentioned that energy is the big driver of, in terms of why we're expecting inflation to come down quite sharply over the coming year. Now, one element of that is wholesale energy prices. Gas in particular, of course, it picked up very, very sharply around a year ago, after the invasion of Ukraine, and market prices for gas, gas futures in particular, have been very high for quite some time. And in the latter half of last year, in particular, there were some periods when there were really some quite scary expectations about how high gas prices might go, and what that might mean for UK energy bills. Now, of course, the government stepped in terms of the price cap, but that price cap has been rising. It increased in January, and it will increase again in April. But the future gas prices, which are determined obviously in global markets, that has come down very rapidly. And so looking ahead, we are more encouraged about energy prices and the fact that they won't be pushing up on inflation in the way that they have been in the past year. Now, another key driver of inflation over recent times have been global developments and global imbalances between some supply and demand, particularly coming out of the COVID period. Now, this chart is showing indications of those global supply pressures around the world, and we take comfort from the fact that these indicators have been receding, indicating that those supply pressures have been alleviating. And that means that the global source of goods inflation is dampening, and also, in addition, it's only relatively recently that China has relaxed its zero COVID policy, meaning that all of the goods that are produced in Chinese factories, that going forward, that should be more stable. And so the international trade, all of these things should be more stable and less disrupted by lockdowns or factory shuts and things like that, which of course has been an ongoing feature of COVID globally over the last few years, particularly in China, because they held that zero COVID policy for a very long time. Now, what does that sort of mean for UK inflation? Well, this chart is showing core goods inflation in orange and core services inflation in turquoise. Now, just now I was talking about global supply chains not being as tough as they had been in previous years under, the most severe times of COVID, and that's helping to pull down goods inflation. And we can already see that here in the orange line. It's come down quite a bit already over the last 12 to 18 months or so. And so that's good news. And now you may recall during the COVID period, people were stuck at home and they couldn't go out and consume services, leisure, eating out, going to the pub, etc. So when people were stuck at home, they were mainly able to purchase goods and goods online, things like home entertainment, gardening equipment, DIY, etc. And that global imbalance between goods demand and supply is what pushed up the price of goods. And now coming out of COVID, that's receding. Conversely, though, coming out of COVID, people have been resuming their purchases of services, and in some cases, services businesses have noticed that actually they can't service demand. They may be supply constrained, and that makes them better able to pass on all the cost increases that they've been seeing. And so we're seeing that showing up in services inflation. And that's why that you can see in the turquoise line that's been trending upwards over the last 12 to 18 months. And we don't yet think that services inflation has peaked yet. Now, services inflation is more domestically determined than goods inflation. And that's because a lot of the goods are manufactured overseas, and we import them. So goods inflation is more globally determined, but services inflation is more domestically determined because, in particular, because it's more dependent on labour. So, if you're running a hairdresser's or a restaurant, you need people to offer the service. And services inflation is more within our control in terms of monetary policy, controlling inflation with interest rates. So this is a key area that we're watching, and we want to see that services inflation is topping out, and we want to see for sure in the data trends that it's coming down before we can be confident that we will meet our target of 2% inflation in a sustainable way in the medium term. And I mentioned that the labour market and pay is a very sort of key area that we're focusing on in particular. And I also mentioned that, the risk that, inflation may be feeding through to wage inflation, and that potentially could feed back through to pricing in a sort of, undesirable dynamic. More recently, this chart is showing, various indicators of pay inflation, and these have started to turn, indicating that perhaps wage inflation might be peaking later this year and may start to come down. The turquoise line shows private sector regular pay inflation, and that has been trending up over the last two or so years. It's around about 7% at present, which we think is not consistent with our 2% inflation target. And so, again, we would need to see that measure of pay growth start to come back down again before we can be more relaxed about the inflation outlook. Now, in the area where I work, my colleagues and I engage directly with businesses to find out, what they're seeing in the economy. And earlier this year, we ran a survey of pay expectations. And this is a survey that we run every year at the beginning of the calendar year. And that survey reported that firms were expecting to give their staff around about 6% in terms of salary increases this calendar year. And that's broadly similar to their expectation for last year. So not too much different, around about 6% in both years. But one interesting feature of the survey results was when we looked within the expectations for 2023, we could see a difference in the sense that those the pay awards being awarded in the first half of the calendar year were higher than in the second half of the calendar year. So that gives us some comfort that pay awards will be easing off going forwards. Another feature in the labour market recently in terms of pay is that many employers have been giving their staff one-off cost of living payments, often perhaps targeted at lower earning staff members below a certain salary threshold, for example. And these sort of payments have been styled in this way deliberately as one-off so that they don't lock in higher labour costs for the companies permanently. And it makes it more affordable for the firms. And it's also a sort of recognition of the fact that, this high inflationary environment is a temporary thing, and therefore, firms are helping their staff out with a one-off payment, but they don't anticipate having to do that again in future. In our survey, we also asked companies to cite, what were the various factors that they took into consideration when they made their pay award for their staff. And you can see the bars at the top of this chart. It was mainly inflation in the economy, be it current inflation or expected inflation, and also what's happening in terms of market rates of pay and the ability to recruit and retain staff. These were the things that were pushing up on salary awards, whereas conversely, profitability and economic uncertainty were pushing down and tempering the rates of pay increases that were being given to staff. One very striking feature of the economy over the last few years is how tight the labour market is. And many of the firms that speak with us tell us that they found it very difficult to hire the right caliber of staff, or people with the appropriate skills and experience. And because of the scarcity of the appropriate skills, that's been pushing up on salary inflation. Firms are having to pay more. Often, if someone has left, they might be leaving for higher pay elsewhere. And when a firm is coming to backfill that for that person, they're finding that they're having to up the salary in order to employ the necessary staff. But more recently, over the last few months, we have been hearing that there is a bit of alleviation in that tightness in the labour market, but it's relatively tentative, and it's also quite patchy in terms of where that's happening in the economy. So on the whole, the labour market still feels very tight, and companies still tell us that they're finding it difficult to recruit. And firms aren't particularly optimistic about that alleviating in a meaningful way, anytime soon. I think there's a sort of recognition that that there is a scarcity of workers out there. So far, I've spoken at length about interest rates, about inflation, and about pay, because these are the big features really that are concerning us at the Bank of England, and also will be influencing our interest rate decisions. So just in the last part of my presentation now, I'm just going to talk about growth and economic activity, because that's also relevant for the inflation outlook. And I'll start with the global sort of growth outlook. Now, we think that that's sort of slowing currently, and we think it's going to be remaining weak in the near term. But things, probably aren't as gloomy as we thought, let's say, 3 to 6 months ago. There has been talk for a long time now about, global slowdown, global recession, and that's because other central banks around the world, at the ECB or the US Federal Reserve, like us, they've all been raising their interest rates as well in order to tackle global inflation. So it's inevitable that there will be some sort of slowdown, but I guess, the big question is, well, how severe a slowdown and how drawn out? And that's still a big unknown. And it sort of depends on, how high interest rates go and how long they'll stay high before any cuts in interest rates might be needed in the future. But within the sort of global outlook, I think it seems likely that there'll be a bit more of a recovery in the US. The US economy is doing quite well, and I think its dynamics suggest that there'll be more of a rebound. Whereas, for example, in the euro area is like us here in the UK, more exposed to gas prices and high gas prices. They're related to Ukraine, which will be dampening economic activity for some time. Now, here in the UK, back in November, we thought that the UK was already in recession. We thought that the recession started last summer and that the second half of last year we were in contraction. But in actual fact, as the data since then has come out, it hasn't been quite as weak as we thought back in November. We had, and in fact, 2.5 weeks ago, we thought that the economy might be modestly growing in the final 3 months of last year. But in fact, the data that's come out since shows that we flatlined at zero in the fourth quarter of 2022. So, what would I say about that? Well, it's sort of not as bad as we previously thought, but it's not great either. It's pretty much stagnation, and we think that there'll be some more of that in this calendar quarter. So minus 0.1. So technically contraction, but very close to stagnation. It's not as bad as perhaps people might have feared, as I said a few months ago, but it's not great either. Now, this chart shows our forecasts over the next few years in purple, and compares it with previous downturns and recessions in the economy. So orange for the 1990s, turquoise for 1980, and gold for the financial crisis period, 2008. And the main takeaway message here is that although it's a gloomy message that we're putting out in terms of the growth outlook for the UK economy, is nowhere near as bad as the previous recessions that we had back in the early 90s, early 80s, and at the time of the financial crisis. Back then, the UK economy shrank by 3%, 5%, or even lost more than 6% of output at the time of the financial crisis. This time round, we think that perhaps, at most, we will lose 1%. So that's quite modest in comparison. However, you can see that the shape of that purple line, we've described as being saucer-like, so sort of shallow but very drawn out, meaning there isn't much in terms of momentum pulling us out of recession and generating a recovery, which is why it's sort of sluggish, and that is going to feel tough economically for a lot of people, because we won't be growing, and things will feel stagnant and sluggish. And you may wonder, well, why is it that we are predicting such a gloomy outlook for economic activity, and why won't there be momentum in terms of generating a recovery? And that's because we're relatively pessimistic about the UK's growth potential. So I'm about to show you a table of numbers here. The UK supply potential is, you can think of it as like the speed limit for the economy. So if the economy grows above its supply potential, that's where demand exceeds supply, and that's what generates inflation. So if our supply limit or supply growth potential is relatively low, it means that we can't grow very much before we generate inflation. That's problematic. Now, if I highlight some of the numbers in this table, for example, the period pre-financial crisis, the 10 years averaging 97 to 2007, we think that the supply growth in the UK was around 2.7%, which is reasonably respectable. And if we break that down between what accounts for that supply growth, most of it was productivity, so about 2 percentage points, and then 0.7 came from labour supply. So workers in the economy, or people working longer in their lives, or working longer hours, or being more productive, and that sort of thing. Now, post-financial crisis, in the years of 2010 to 2019, so just before COVID, that growth potential here in the UK had slowed quite a bit, from 2.7 down to only 1.7. But the mix had also changed. So previously, pre-financial crisis, it's been mainly productivity. But in that sort of 10 years or so pre-COVID, most of our growth potential was really driven by labour supply. So that was, as I say, more workers, or people working longer in their lives, or working more productively. Whereas our productivity growth post-financial crisis was pretty weak. It had come down from 2% to only 0.5%. And looking ahead, we think that our growth potential is pretty low. So we think it'll be less than 1% next year and the year after. And the main reason for that is because we see productivity growth remaining weak, only around half a percentage point. And in particular, we see labour supply growth being very weak, barely positive, 0.2 next year, 0.1. It's these factors that constrain our growth outlook. The fact that we're not seeing productivity growth, and we're not seeing the labour supply, so it means it's difficult for the economy to grow very quickly without generating inflation. I'll go on to sort of illustrate a bit more about sort of where that's coming from. Now, this chart shows data for what economists describe as economic inactivity. So that's people who are not active in the labour force. So they're not working and they're not looking for work. And why might that be? Well, it could be because they're studying, or it could be because they're sick and not able to work, or caring for family members, or it could be because they've retired. This chart shows over the past couple of years since COVID, more people have become inactive, or meaning they've left the labour force. They're not working anymore, and they're not looking for work. And most of that can be accounted for by people aged 50 and over. So you can see here the orange bars are the people aged 50 to 64, and the turquoise bars are people aged 65 plus. So and certainly we've heard that anecdotally as well in terms of our conversations with businesses. We've heard that more people have retired early, and it may have been the experience of COVID. It was a very difficult time, people perhaps decided they didn't need to work anymore. Maybe they had sufficient savings, and they left the labour force. But the number of people that have left is significant. So you can see, some 600,000 to 800,000 people have left the labour force over the last few years, and that's a contributing factor as to why the labour market is so tight. Of course, during COVID and related to Brexit, EU national workers left the country as well. So that's another factor as well. Now, this chart is showing labour participation. So that is the opposite, the inverse, if you like, of the chart that I previously showed you. So this is people that are in work or are looking for work. And you can see that since the end of 2019, i.e. over the COVID period, in the white line, that participation rate has fallen. We think because of those dynamics in terms of demographics and other features about the UK labour market, we think it's, this labour market participation is going to be relatively slow to recover. And that's why we think the UK's growth potential is relatively weak. Now, the last chart that I'm going to show you is this one on UK business investment. And this relates back to what I was talking about earlier in terms of productivity. So productivity could be, innovation, research and development, new equipment, or expanding or refurbishing your buildings in terms of, enhancing our efficiency and making, making more with less, in terms of efficiency. Business investment is a key driver of productivity, and business investment in the UK, sort of flatlined after the EU referendum, and then it dropped significantly during COVID, and it's recovering, but it hasn't yet recovered its previous level. So that's very weak. Now, this is the aggregate picture, which is relatively weak in terms of business investment. Of course, if you look sort of under the headline figures, there are various different trends affecting business investment. The fact that energy prices have been so high, for example, has been stimulating certain types of investment. Let's say renewable energy. Lots of businesses have been telling us, for example, that they've let's say installed solar panels on their building, that sort of thing. So there are certain things that are driving investment, but there are other things that are also deterring investment. So a high inflation environment means that equipment is more expensive. So, even if you wanted to invest in the latest technology, it's more costly to do so, which means that you might not be able to afford it currently. And also given the sort of weaker economic outlook, you may be less confident about your ability to get a return on the investment. So that may also be another deterrent. This is a sort of factor in terms of why we think the growth environment is relatively gloomy. We, in terms of our remit and our targets, we are targeting 2% inflation in the medium term, and that will depend on how quickly the economy grows and whether it is generating inflation or not. So if the economy can't grow much without generating inflation, then that means that we'll have to be more careful in terms of monitoring those inflation dynamics in the outlook.